How do you know if a company is good at what it does? And how do you know if the company is getting better or worse over time? If a company's objective is to sell goods and services at a profit, then the income statement will tell you if it's succeeding or failing, which is what we'll be diving into in this lesson, so let's get started. In this lesson, we'll be using our fictitious sailboat company to explore the income statement in detail. As we get deeper on this topic, recall that the income statement and the cash flow statement link consecutive balance sheets to each other by showing the economic activity of the business during each accounting period. I think this visual is extremely helpful as we build on the three primary financial statements. But what exactly is the income statement? In the most general sense, it shows a company's revenue less its expenses. The result, literally the bottom line, is net income. That makes the income statement the base metric of a business's profit-making ability. To understand it better, in the sections that follow, we'll investigate revenue recognition, the organization of expenses, and some additional fundamental concepts supporting it. To get started, let's talk about how tempting it is for business executives to book revenue any way they can. And for a real-world example, what's more tempting than some delicious Krispy Kreme donuts? Krispy Kreme was founded during the Great Depression, and it went public in 2000 when the dot-com bubble was reaching its peak. People just liked it better because it was easier to understand. And as tech stocks bottomed out in the years following the dot-com bubble, Krispy Kreme performed very well, going from an IPO of $21 per share to over $49 by August 2003. To keep Wall Street analysts happy, the company started inflating earnings by selling equipment to its own franchisees at high margins, well before the equipment was needed. So the equipment would just sit unused for months in trailers controlled by Krispy Kreme, and franchisees didn't have to pay until it was actually installed. They would also sell expensive equipment to franchisees, book it as revenue, and then buy the franchisee for an inflated price. So Krispy Kreme was willing to both accelerate expenses by shipping equipment before it was needed and increase the cost of its acquisitions, all in the name of booking revenue sooner and pleasing Wall Street analysts. When they got caught, the company had to revise its results downward all the way back to its IPO, and the company's share price cratered in response. I mean, it got crushed. For so long as fortunes are tied to financial performance, there will be attempts to exaggerate it, which is just one reason I think financial literacy is so important. Hopefully, understanding the rules helps you spot when they're being broken. And with that in mind, let's move on to the revenue recognition principle. If you want to work in investment banking or private equity, it's unlikely that you'll be asked to detail the rules for revenue recognition. It's far more important to understand the quality of a company's revenue than it is to be able to elaborate on esoteric accounting principles. But it's helpful to understand revenue recognition on a conceptual basis. And the most important thing about the concept is this. The revenue recognition principle states that revenue should be recorded when it is earned. In other words, revenue is recognized when the good or service is considered delivered to the customer and not necessarily when cash is collected from the customer. Unfortunately, the rules for recording revenue run 700 pages in length. Fortunately, I think we can condense it to one slide. So remember, the revenue recognition principle states that revenue should be recorded when it is earned. I don't normally reference outdated accounting standards, but in this instance, I think it's instructive. Previously, 4 conditions were required to recognize revenue. The first, persuasive evidence of an arrangement for customer payment. Next, delivery has occurred or services have been rendered. The price must be fixed or determinable. And finally, collection must be reasonably assured. But in May of 2014, the Financial Accounting Standards Board updated GAAP, and now we have a 5-step approach to revenue recognition. First, you must identify the customer contract, then the performance obligations in the contract. After that, you have to determine the transaction price. Fourth, you have to allocate the transaction price to the performance obligations in the contract. Finally, recognize revenue when the performance obligations are met. I find the pre-2014 criteria easier to explain to anyone new to the industry. For instance, it's easy to look back at the Krispy Kreme example and see how the conditions were violated. If you ship donut-making equipment to a franchisee before they need it or want it, then delivery hasn't really occurred. This fact can also be explained with the new conditions, but I find the language of the previous regime to be a little friendlier. Hopefully, reading both the old and new criteria will help you get your head around what it means to earn revenue. After revenue, we have expenses. The income statement has different categories of expenses, and between each of these line items, we have different measures of profitability, each of which communicates something unique about the company's ability to successfully sell a good or service. So let's expand the income statement from our initial 3-line framework to review more detail. First, we have cost of goods sold, or COGS. These are the costs directly associated with providing the goods or services to the customer. They are also called direct expenses and include the cost of materials used to create the products as well as direct labor costs. In our sailboat business, examples would include wood, fabric, and the labor employed in putting the boats together. Subtracting COGS from revenue gets us gross profit, our first measure of profitability, which we have color-coded with a different background so you know when we're referencing an expense or a measure of profitability. This represents the profit realized from making the product. After that, we have selling, general, and administrative expense, or SG&A, also known as operating expenses or indirect expenses. They include all major non-production expenses incurred in running the company. In the sailboat business, it might include anything from executive salaries, the marketing budget, to office supplies. Subtracting SG&A from gross profit gets us to operating income, or EBIT, which stands for earnings before interest and taxes, and shows us the profitability related to the core operation of the business. After that, we have interest expense, the cost of borrowing money, like a loan from a bank, for example. And this is one example of a tax shield. Since this expense is deducted from revenue before taxes are calculated, it lowers the company's tax burden, shielding it from taxes. And next we have tax expense. Profitable businesses have to pay taxes to various levels of governments, which finally brings us to net income. Pulling interest and tax expense out of operating income leaves us with this measure of profitability. It is quite literally the bottom line. Now at the bottom, you'll see we've included EBITDA. To be clear, EBITDA, or earnings before interest, taxes, depreciation, and amortization, is not recognized under GAAP. And you wouldn't find it on most income statements, but it's used constantly in financial models, which is why we want to include it as a measure of profitability. This metric will get a lot more attention in future lessons. For now, let's move on to some critical accounting concepts. First, we'll start with the matching principle. Measuring how successful a company is at selling its goods or services also requires a proper matching of expenses to revenue. The matching principle is a fundamental accounting concept that requires companies to record expenses in the same period as the revenues they are related to. In other words, revenues and expenses are matched on the income statement in the same accounting period. This provides a better view of a business's profitability than recording revenue and expenses when cash is received or paid out. An example will make this clear. Our sailboat company earns revenue from selling boats, which are built by incurring expenses on labor and materials such as lumber. On a cash basis, if we build one boat in the first accounting period, spending $2 million on labor and $3 million on materials, because these are really great looking boats, then direct expenses or COGS for the period are $5 million. If the boat has not sold by the end of the period, the company will show a gross profit of negative $5 million for period 1. Now assume the boat is not sold until period 3, when it brings in $10 million. If no other boats have been built and sold, then period 3 gross profit will be $10 million. It's easy to see why this approach fails to produce an accurate picture. The story the cash basis statement tells us is of a business experiencing stratospheric growth in profitability, from negative $5 million to 0 to $10 million. A rough projection of this trend might lead one to predict that this company could expect to earn gross profit of $30 million in period 4, all because revenue and expenses are not being matched properly. To get an income statement that tells a more accurate story, especially in period 3, we need to account for revenue and expenses on an accrual basis, which uses the matching principle. Since we sold the boat in period 3, that's when the expense associated with building the boat should be recognized, even though they were actually paid in period 1. Now we have a statement that tells a story of a company that spent its first 2 weeks making no gross profit, followed by $5 million gross profit in period 3. So we know how good this company is at selling boats. By matching revenue and expenses, we see it can generate a 50% gross margin. But it takes more than labor and materials to build a boat. We also need equipment. So let's explore another accounting concept to bring equipment into the picture. Another critical concept to accurate income statements is depreciation. This concept involves taking the costs of a company's long-term tangible assets and allocating it over the asset's useful life. We will expand on this momentarily, but first, some related vocabulary, because we need to introduce capital expenditures. So what is a capital expenditure? These are funds used to purchase and maintain tangible assets, and they appear under the property, plant, and equipment line of the balance sheet. If that feels a little abstract, this example will help. So let's explore how depreciation works. To better illustrate this point, let's go back and modify the income statement of our sailboat business. Let's assume that we decided the business needed its own crane, and we bought one in period 1 for $5 million. Since we are accounting on an accrual basis, we record the expense of the crane in period 3 when the boat sells. This means that instead of $5 million gross profit in period 3, we will now show $0. Does that make sense? Is it telling the story accurately? Not really. The problem is that while material and labors get completely consumed in that period, the equipment does not. A crane is built to provide many years of service. It can help produce many more boats than just the first one, which brings us to the concept of a useful life. The cost of a long-term asset such as a crane should be depreciated over the full course of its useful life. This allows the company to spread the cost of the asset across multiple periods, as you can see here in the image. Let's assume that the periods in our example are years and that the crane has a useful life of 5 years. What we've done is depreciate the crane in equal installments over its full useful life. And by depreciating the asset rather than recording its full cost in period 3, gross profit goes from 0 in period 3 to $4 million. It's a more accurate story because the crane is going to be used in multiple periods. In fact, if we were to assume that the company could sell a boat in each period, then you could see how well the matching principle and depreciation work together to tell a more accurate story of a firm's profitability or success in selling its goods or services over time. As we're getting close to wrapping up, I want to talk about a link between the income statement and the cash flow statement. And to do that, we can revisit the expanded accounting equation. If this is our balance sheet across the top, then the blue triangle shows how the income statement fits into the overall picture. In the image, you will see that net income is equal to revenue less expenses, which mirrors the simple 3-line income statement this lesson started with. From one balance sheet to the next, retained earnings grows or shrinks by the amount of net income less any dividends. From a business point of view, as a company earns profit selling its goods and services, this money settles in the company's balance sheet, financing the continuing operation of the business unless and until it leaves the business by being paid out to owners. Before closing out today's lesson, and by way of a segue to the next lesson, I want to point out one more key connection, the one between the income statement and the cash flow statement. The income statement ends with net income. It's distilled from accounting rules, not cash movement, and it's based on revenue being recognized when it's earned and expenses being matched to that revenue. That's accrual-based accounting. This endpoint for the income statement becomes the starting point for the cash flow statement, which will take accrual-based net income and translate it into a figure representing actual cash earnings over the period. And with that in mind, we can move on to the next lesson, which covers the cash flow statement. All right, team. Thanks for watching.